Where does the money go when the market crashes? The secret wealth transfer. Every time the stock market crashes, the headlines sound terrifying. Trillions of dollars wiped out overnight. And when people see their portfolios dropping fast, they start asking the same question. Where did all the money go? Did it disappear? Did someone steal it? Or did it never truly exist in the first place? Here's the truth. When the market crashes, money usually doesn't vanish. What actually happens is a massive transfer of wealth from emotional investors to patient investors. And once you understand this, you'll never look at market crashes the same way again. Let's make this simple. Imagine you own a house. Last year, a realtor said your home was worth $500,000. This year, because the economy slowed down, another realtor says it's worth $450,000. So did $50,000 suddenly disappear from your bank account? No, your house is still there. The only thing that changed was the price people are willing to pay at that moment. That's exactly how the stock market works. The market is not a giant vault filled with cash. It's a giant auction. Every second, buyers and sellers are deciding what stocks are worth. And your portfolio balance is simply today's auction price, not guaranteed cash in your pocket. That's an important difference. Now let's talk about paper losses. If your portfolio falls from $100,000 to $70,000, it feels painful, but technically you haven't really lost real money until you sell. That's why it's called a paper loss. The moment you panic and hit the sell button, the loss becomes real. And this is where the secret wealth transfer happens. During crashes, most people panic. They watch scary news, they see red numbers everywhere. Fear takes over, so they sell their investments at huge discounts. But while panic sellers are running away, another group is calmly buying. These are long-term investors, pension funds, and experienced wealth builders. Think about it like this. Imagine a fire alarm goes off inside a department store. People panic and throw expensive jackets onto the floor while rushing to the exit. The jackets are still valuable, but fear makes people abandon them cheaply. Meanwhile, calm shoppers quietly pick them up for half price. That's exactly what happens during a market crash. The impatient sell valuable assets cheaply. The patient buy them at discounts. But why do crashes sometimes fall so fast? Because it's not always emotional selling. Sometimes it's forced selling. Large institutions often borrow money to buy stocks. When prices drop too much, banks demand their money back. This is called a margin call. And when that happens, investors are forced to sell quickly to raise cash. That forced selling pushes prices down even further, which triggers even more selling. It becomes a domino effect, and suddenly markets crash much faster than expected. But remember this, a falling stock price does not always mean the business itself became worthless overnight. Sometimes fear is simply overwhelming the market. So where does the money actually go? Most of it moves into safer places. Some investors move into cash. Others buy government bonds or gold. Many simply wait on the sidelines for the panic to end. And eventually, that money flows back into the market. That's why recoveries often happen faster than people expect. History has shown this again and again. The market recovered after the 2008 financial crisis. It recovered after the 2020 COVID crash. It recovered after inflation fears and recessions, because despite short-term panic, the long-term direction of the market has historically moved upward. Not every year, not every month, but over long periods of time. So the next time you hear headlines saying trillions wiped out, remember this. The market is an auction. Prices change based on fear and emotion, and crashes are often less about money disappearing and more about ownership changing hands. The emotional investors sell, the patient investors buy. That is the secret wealth transfer. So when the next crash happens, ask yourself, will you be the person throwing the jacket on the floor or the calm investor picking it up at a discount? And more importantly, what's your plan when the market goes on sale again? If you enjoyed this video, don't forget to like, subscribe, and share it with someone who wants to become smarter with money.
Enjoyed the video? Like, subscribe, comment, and share the investing mindset with others. Thanks.